What is going on? Welcome to my channel. I'm the Covered Call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income just using Covered Call ETFs, subject to change when I do reach my goal of $120,000. As of right now, my projected annual dividend slash options income is about $82,000 a year, 6.8K a month, 1.5K a week, $226 a day, and roughly $9.42 per hour. Legal disclaimer before I start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own. It may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, let's get started. Today's video, I hope it's going to be simple and quick. It's just going to be asking yourselves, right, is your high yield ETF a ticking time bomb, right? You're going to be watching for those ABCs. What do I mean by that? We're going to be doing analysis of recovery-shaped letters, risks, and covered call ETF strategies. For those who are new, I talk about the V shape a lot. Well, for those who've been watching, this is something new. There are multiple type of letter-shaped recoveries, and we're going to be talking about it. The most prominent that I talk about is the V shape, right? That is the most ideal, right? I always talk about how your covered call ETF should type of, especially your cores should be aiming for this type of recovery, the V shape. All right, but we're going to talk about a few others. But first off, right, the alphabet of recovery, right? It's just not about interest. What do I mean by that, right? You got to ignore the noise, right? Don't focus too much on the expense ratio. It does matter. Don't focus too much about the assets under management. It does matter. Don't focus on the yield. It does matter. But what I mean is you got to pick apart from the destroyers to the winners, right? We're breaking down the recovery shape, right? The structure, what's underneath the hood. That is how you can rank from the most destructive to the most favorable for your covered call ETF pick, right? Look beyond it. The reality is the shape of the chart determines the solvency of the covered call ETFs, right? Not the yield percentage. All right, worst case, we are going to start off with the letter L. This is the apex predator of risk. Your capital is permanently impaired, right? Look at that trajectory, right? A severe vertical drop, right? A hard dip to a crash, followed by a horizontal line, right? Stagnation that persists for years, right? This is the mechanism of destruction. You participate fully in the crash, and then during the stagnation, the volatility crashes, so premiums are too small to rebuild NAV. You effectively lock in the loss forever, right? My verdict here, right? You are paying yourself a yield from a permanently shrunken capital base, and all it does is get smaller, smaller, and smaller. This is the worst case scenario. When you look back at the charts, if there is historical data, right? I always try to have especially your cores have at the minimum 1 year. I preferably at least 3 years. That way, the last 3 years, you were able to see through, the dips, the recovery. You kind of have an idea on how their structural strategy holds. So letter L, the worst case. All right, the hidden L trap, right? The optical illusion behind it is that you think you're safe because the market is showing a V-shaped recovery. I'm going to say you're wrong, right? A covered call ETF can experience an L-shaped return even if the market V-shapes. The market charts can look like a V, but your charts look like an L, okay? I want to make this as simple as possible. I know there's been some comments asking on, well, how can you determine? I know one of the comments was from Greg, so I guess this could be a follow-up from one of the comments from Greg. Shout out to Greg. Thank you for that. This kind of brought me to my video idea here. So I guess for those who are new for the covered call ETFs or income investing, you can start looking for, if you're not great at chart analysis, well, you can kind of determine just by looking at, going 1 year, 2 year, 3 year back, or just look at max and see how it performs, right? If it shows you an L and is not recovering, well, that is kind of a red flag. What is the brutal math behind the letter L? All right, we're going to look at the math on a fully covered at the money strategy. Let's look at month one, right? The market drops 30%. You drop anywhere from 28 to 29, right? Buffered slightly buy the premium. Month 2, let's say the market rallies 30%, a fast V-shaped recovery. The trap here is because you sold at the money calls, your upside is capped at the premium, anywhere from 2%, maybe maxed 5%, right? The result here is the market is back to even. You are still down roughly 26% because you are trapped at the bottom, right? My verdict here is volatility is only your friend if you're allowed to participate in the upside. All right, so watch list for these, the most popular, the vulnerable tickers or TSLY, right? The staircase to zero drops when with Tesla but fails to recover. The result here is that it forces reverse splits, L-shaped or downward sloping nav. QQY, daily capping creates path dependency, right? So multi-day drops are felt fully. A multi-day rally are capped daily, right? QYLD, I know I get a comment from this saying, why do I use QYLD a lot in all my videos? It's just because they are one of the biggest. They are still one of the most popular. People end up, especially new income investors or covered call ETF investors, end up choosing QYLD because it is still popular, it's still pretty big, and it's still talked about. So I like to put it in a lot of my videos to say, hey, stay away from funds like these. It has historically struggled to reclaim NAV highs. Why? It creates a long-term L relative to the QQ index. All right, volatility whip. The letter W, right? So the trajectory here is a double dip recession. Drop, falls down, drop again, recover. The mechanism of stress, this is what I call a whipsaw nightmare for you, okay? Look at leg 1. The market crashes, right? So you drop. Leg 2 is the, leg 1, boom. Leg 2 is the false down. You right calls at the bottom, rally blows through the strike, capping you. Leg 3 is the second down, right? Boom, boom. Wait, is my mouse showing? Okay. Second drop, you start from a lower high, you capture 2 drops and then 0 rallies right here. Associated ticker here, I would say, is RYLD. The second small caps of Russell 2000 are prone to this. Principal erodes before the final recovery begins is right here. So you're taking the leg 1, fake, you got faked out, goes up, faked out again, and then it really drops from the leg 3, right? Oof. All right, the sweet spot, the letter U, right? The Goldilocks scenario trajectory here is steep decline, prolonged bottoming through gradual rises, right? So it drops, and if you're smart enough, if you have a great cover call ETFs, if you have great conviction and thesis, you buy here, let it go back up, you're okay. Then it really drops down, and this is where you still end up buying again, right? And then the trout is during this uncertainty, you can repeatedly harvest premiums without being called away. The recovery, right, the gradual rise rarely breach your strike prices. You capture slow growth plus dividends. So this is where you are aiming to buy all of the dips here. This is where you got to be buying, and then when it fully recovers, then you kind of, all right, cool off. I'm gonna go ahead and buy something else. All right, the winners for these, for the examples, will be XYLD, and JetB performs best here, right, weathering through the drought and capturing slow growth. All right, the best case is the dynamic V-shaped recovery, as you can see here, right? That hard dip. Look at that. Look at that big red dip here, right? And then it just shoots back up, right? So this is the check mark, right? Sharp drop, aggressive rally is historically difficult, but modern ETF are engineered for, right? Mechanism of success is, unlike QYLD, which is at the money, the best funds use out of the money calls or call spreads, right? So out of the money calls sells upsides 2 to 5% higher. You capture the first 2 to 5% of the V shape every month. It doesn't sound like much, but the difference is between solvency and decay. That is literally the fine line between the two, right? Call spreads, this strategy caps the loss on the option side, effectively uncapping your stock upside during violent rallies, right? So some of these high recovery potential is GPIX, GPIQ, SPY-I, QQI. So these aim to capture the right tail that L risk funds miss. And I haven't had any historical data or when the actual testing of the new boost news ETF comes out, we will really be looking if they can do this hard V-shaped recovery. I have no doubt they can, because when it's a bull market, that's when they should perform the best. So we should be looking at these boosted funds if they can actually hold through the bear market and really have that sharp V-shaped recovery. I will be going deep into these funds. All right, so watch list, right? Risk breakdown here is a systematic erosion. Like I mentioned here, the tickers are QYLD. These are just some examples, or RYLD, and sometimes it could be XYLD, right? The risk level here is that high to extreme. Why? They're 100% at the money, right? Coverage guarantees inability to recover from sharp drawdowns, right? And then we have the accelerated L, right? The tickers are TSLY, QQY, and GEPY. The risk level here, I want to put them at critical. Why? Because of volatility decay. Missing the best days guarantee a mathematical L. It's just the basic math behind it, right? And of course, we want the modern structure. The tickers is GPIX and SPY. Risk level, I'm going to say low. Why? Partial coverage out of the money strikes allow for convexity here. All right, mechanism, delta gamma dislocation. What do I mean by that? We're going to explain. I'm going to explain it in two phases. The phase one is the drop. When the market crashes with the vertical leg, you are essentially long delta. As the market plunges, your short calls becomes far out of the money, right? It stops hedging you. You fall into lockstep with the index. Phase two, though, is the trap. At the bottom, your share prices is depressed. To generate income, the manager must write new calls at new lower strikes. If the market rallies back to $50, you are capped at $35. You lock in the loss. The result here is that you own the downside. You rent out the upside. Okay, this could be an issue if your fund does this. Essentially, every cover call ETFs fund will experience this. It's just to what degree, right? So at the money, like QYLD, right? These at 100% at the money will experience this on a harsher scale. GPIX and QQI can experience it, right? But to a very different degree, because of how aggressively they overwrite and how they reset calls after a drop. Remember, they do monthly, right? Because it's not fully overwritten and can dial coverage down. It usually participates more in rebounds than a QYLD style fund, right? So the locked in loss effect is milder, though the upside is still partially capped after big sell off. We still see that V-shaped shooting up recovery, right? They're a lot more fine-tuned to kind of capture a better NAV preserving gains, so to speak. All right, the strike price ratchet, right? So this phenomenon is called the strike price ratchet. In a secular bear market, strike prices are systematically lowered month after month. You participate fully in a drop from 100 to 80, but you miss the rally from 82 to 85 because you were capped, right? So mathematical impossibility, you ratchet your NAV lower, it becomes mathematically impossible to return to par without an unprecedented streak of perfect low volatility gains, right? Mechanism, it acts like a ratchet wrench that only turns one way, down. You have to be very careful. Just look at the charts. If it has historical data, look at how it's jumping up and down. What letter is it forming? What letter is it consistently forming, right? All right, macro, why the Fed can't save you, right? The Federal Reserve, it matters. The stuck at the bottom problem. All right, think of the economy as a car. Usually when it crashes, in recession, the Fed hit the gas, cut rates to speed up recovery. But what we call inverse L curve means inflation is like a brick wall. If the Fed hits the gas, we hit the wall. The result, we have to keep the brakes on high rates. This forces the market to drive flat, which is stagnation, instead of bouncing back, right? This flat line is where covered calls die. It's a simple truth. No rate cuts equals no rate V-shaped recovery equals the letter L trapped. Not always. It's just very dependent on how your covered call executes their strategy. But if you have certain covered call ETFs and you're looking at the historical data and you're looking at what type of ABC letters they're making, this will give you an idea on how it will perform. All right, that's it. I hope this video was nice and short. My final verdict before we end, I'll give you a simple truth. If you rely on 100% at the money strategies, you are slowly bleeding out. If you chase daily option cap, you're sprinting off a cliff. I'm going to say, at least in my opinion, the only way to survive this math is to own the upside. Move your money to funds with convexity like GPIX or SPY, or you can accept the loss. Again, I don't hate any of these strategies. They work best for certain people, certain environments. But I'm going to say, if you're new, at least income covered call ETFs, if you're new, pick a core that can actually own the upside. If you're capping yourself because you know what, I just need the money, I have no, I don't need to pass down anything, I don't need to give away any of my assets, that also works for you. Some people choose that because you know what, they don't have kids, they're living life, and they're not gonna be, they're just gonna spend all the money. That works too. So there's two different sides. But if you're new, you most likely don't fit into that. I know very, very few people that actually use that strategy. Very few people. If you're one of them, you can leave it in the comments, because I'll be interested in, you'll be like one of the first few people that actually know that just caps 100% at the money. So own the upside, long-term survival. This is what I'm all about. Also, I encourage you to go ahead and continue to choose cores that have these upside captures. Don't get trapped. All right? Don't get trapped. Like, comment, and subscribe for more financial truths. That's what I'm about. I'll give you the pros and the cons. I know I talk about GPIX a lot and SPY. I will be making a video on why. Thanks for watching. Stay tuned. Catch you guys on the next.